There are tons of business podcasts to choose from, but only one has the stamp of approval. Kristin Stampini is South Florida's leading real estate entrepreneur and your trusted source for everything real estate.
I would like to welcome my listeners and thank you for joining us today for another episode of my podcast, The Stamp of Approval. I'm Kristin Stampini, co-founder of the Stampini Platinum Real Estate Group with RE/MAX in Boca Raton, Florida. I'm also a certified real estate coach with the Craig Proctor system and the owner of Global Virtual Real Estate Assistants. You may have heard us on the radio. I'm a real estate investor, a national trainer and public speaker, and a certified inside sales agent trainer. The Stamp of Approval podcast was launched to share and educate other realtors, consumers, and other business owners across North America by sharing value and content to each of our listeners every single time. And here today, brought back Matt again, because Matt is everybody always wants Matt to come back. So here we are again with Matt Weaver. And as a seasoned mortgage loan originator, Matt Weaver has dedicated his life work to servicing the mortgage needs of the South Florida community for over 20 years. In 2016, Matt was ranked 22nd in the nation for the most closed transactions by Scotsman Guide. He also remains a top of the list of producing originators in the United States. Matt currently serves as a loan originator and vice president of sales for Matt Weaver team Cross Country Mortgage, one of the largest lending teams in the nation with 32 professionals serving every aspect of the mortgage transaction. Matt is known for his impeccable closing rate, thanks to having one of the most thorough pre-approval processes in the industry. Much of Matt's success and reputation hinge on the consistent execution of his 4 pillars of value, uniquely designed to increase real estate partners' sales productivity and efficiency. So Matt, here today in this episode, we're going to be discussing, with a changing market, the different kind of lending options we have today and maybe foresee in the future that are non-traditional fixed 15 and 30-year mortgages. So welcome, Matt. Thank you for coming back.
Thank you so much. Just a quick question for you.
Absolutely.
How'd you like that Heat game on Saturday?
That was my first one. Yeah. So for the first game of the year for us, because we have season tickets that we split with one other person.
Sure.
So we go to, 22 games a year, 21 or something like that. And I'll tell you what, that was a great game to go to.
Electricity.
I sure was. And I was on fire during that game. Anyways, okay, so Matt, thank you again for coming back. And let's talk, today about, our consumers and other agents out there too are looking at trying to, help the buyers, structure different loans and what's happening today. And, how can you see the market going? And, people are like, oh my gosh, are we going to have, the no income documentation and all that stuff coming back? And, or what are we going to see?
Well, great question. And, it's interesting. I was speaking at a real estate office a few weeks back, and I said to myself, before I go in, what can I leave them with value, right? Like what value proposition can I leave on the table as I'm exiting? And I wrote down, no stone unturned. And what I mean by that is, for those agents out there, buy side, list side, no stone unturned. When we are entering a perhaps shifting style market, I think we can agree that every transaction counts on all levels. So I run a big team. I run a team of 32. And what we're doing is we're constantly reshifting ourselves internally. And what I said to my team of reviewers that review all of our pre-approvals, I said, we have to almost unwind what we think we know and then retool back up, because the market is changing by way of product every single day. So the term inside of my office is triple check all the time. And so what I mean by that is, okay, there's the traditional conventional loan, there's the traditional FHA and VA and jumbo loans. Okay, they're great. They're out there. They're pretty liberal in terms of being able to qualify. Some are a little bit more stringent than others. But what's happening right now is a lot of alternative products are coming to the set. Okay, and what I mean by alternative products, we're talking, I'll give you an example. The self-employed borrower has always had a challenge, right? They have the ability to craft their own tax returns, we'll say. They can get a little creative, right?
Yeah.
I'm sure real estate agents don't know what that means,
No,
right?
not at all. Not at all.
So with that said, the bank statement only program has made its way to the scene about 36 months ago. Wasn't really popular 36 months ago. Wasn't even really that popular 24 months ago. But now the amount of inquiries we see on a monthly basis is climbing every day. That buyer has accumulated funds over the past 24 to 36 months that maybe they didn't have that 20% down payment 2 or 3 years ago, but now they do. And now they can understand they can supply bank statements as opposed to tax returns to qualify. Now, the famous line, Kristin, don't throw tomatoes at me. I'm just the messenger here, okay? I'm not condoning or endorsing.
Right.
But it's a product that's out there. And so that's one of the more popular products that's in the marketplace today.
Okay, awesome. And, what other, when you're looking at all the different things that aren't traditional and not conventional, not your FHA or your VA, are they having other products that they're coming out with all the time, right? So should the consumer or agent, let their buyers know to run, or, are we gonna look at a crash like we were, back in 2006, 7, 8, 9, 10, 11?
Okay, so big difference between today and then. And I was in the industry then, right? I'm 20 years, and for those that can't see me, I have a lot of gray hair at my 39 years of age, okay? I mean, it's like dog years, right? Every 1 year equals like 3 or 4. But with that said, the difference between, let's say, 02, 03, 04, 05, 06, you had very little skin in the game. The amount of money you had in the deal to get finance was like virtually nothing. I mean, they had like 100% products there with no income, no assets, no nothing. I mean, just breathe, sign, and drive. So, of course, that is extremely unhealthy. The difference here today is with those alternative products that are coming to the table requires a lot of a down payment, or a larger down payment, I should say. So you're looking at anywhere between 15 to 20 to 25% down for a lot of these products. So that's going to be a big hedge. I think we can agree that once someone has some skin in the game,
That's right.
They reconsider walking on that note, right? Or walking on that house.
So you don't see them loosening up on that to going to 5% or 0% down and things like that.
I think that would be such a huge risk assessment. I think that market is becoming very competitive right now, meaning there's a lot of players now coming into the scene that are bringing these alternative products to the table. But what they're doing is that they're not necessarily compromising the amount of payment, or meaning down payment. They're actually compromising more of rate. So they'll take a less of a rate of return, but keep the down payment the same. Does that make sense?
Yeah.
So I'll give you another example. Another popular product is, let's say someone had a foreclosure, 2 months ago. There's a product for that, right? Which sounds crazy. But there's a portfolio product out there right now that is strictly asset-based. So they look at your assets and then they unwind what that would look like if you annuitize those assets, as opposed to looking at the income. The biggest challenge for someone not being able to qualify for traditional financing is basically income. And so these products that are coming out are catered for those that really can't verify their income. Because look, the amount of inquiries we get over the past 2 or 3 years is, I got $500,000 in the bank and I can't even buy a home, or I can't qualify. Right?
That's right.
And that's because of the ability to repay, right? So post 2008, it became virtually a lending law that lenders must verify the ability to repay. So tax returns and income outweigh down payment and cash to close. Because the way the lending world looks at it is that's great. You have $500,000 in the bank, but you don't have any income. That money you could go and blow in Vegas next week.
That's right.
Right?
That's right.
We have to pin you to the income. So
what about interest rates? Where are we at? I mean, this year, where have we gone, and what do we think, where do you think we're going to go?
Absolutely. So interest rates are in the high 4s, low 5s. I mean, it's been a heck of a run the past year. And let me tell you something, not a lot of fun from my side of the world. Okay.
Right. So how much have you seen it go up in the last year?
Over 1%.
Wow.
And it doesn't sound like a lot, but there's a huge mental adjustment from 4.999999 to 5%.
That's right.
Even though the payment is 0.001 cent.
Right.
But just to hear the number 5 is a very large adjustment for our marketplace, because we have been really spoiled for years with interest rates being so low. The federal prime rate right now is 5.25% and expected to adjust one more time by year end, weighing in at 5.5%. Now, you ready for my crystal ball, Kristin?
I am.
Okay. So here's my thought process. I happen to believe that we're going to see a market correction with the stock market. I said that about 2.5 weeks ago. We're starting to already see that deterioration right now, which in turn is going to pull the 10-year treasury down, which in turn will bring interest rates down a little bit. So I happen to believe we're going to see and rest in the upper fours going in closing Q4 and perhaps going into Q1. So what is that worth to the listeners right now? Exactly what you paid for it. 0.
And that's your crystal ball.
There it is.
Yeah.
There it is.
So, a lot of the, we hear a lot of the buyers out there and such that are sitting here and they're saying, I want to wait until prices come down, or I want to look and see, I want to wait until the interest rates come down. And, we hear that often. So what do you say to those people?
Well, I was told by a very wise man, very prudent man, that you never try to sharpshoot a bottom. It's, it's something that most experts can't even do. When you're purchasing a home, it's not necessarily purchasing, let's say, a shirt at Macy's, right? This is some place that you're going to house your family. You have a lot of financial benefit behind it. You have a lot of tax deduction behind it and so on. So I think if we take it up against renting, because rents have gone so high at this point, you don't get the tax deduction behind it. Overall, we all know that real estate, in terms of ownership of it, you cannot go wrong. So I wouldn't hesitate or wait. I happen to believe that we're not going to see any type of real huge market correction. So let's say pricing comes down 5%. Let's just use that as a barometer. Okay, so you don't buy now, and miraculously you happen to sharpshoot it a year from now, and it's down 5%. Well, what did you pay in rent? What did you lose in terms of tax deduction? Did you have to, watch this, just the movers alone. Just the movers alone is a few $1,000s. So the question becomes, are you really saving? So I think we have to look at real estate and the home that we live in as a long-term asset and a long-term value, right? I mean, we're not trading stock. I mean, it's a house that you're going to live in.
Yeah, that's right. And as an investor, okay, because I'm an investor on many, many properties now today, one of the things we're looking at purchasing another investment. And we just closed on one last month.
Oh, congratulations.
Well, thank you. But we're always looking, for investments. And the thing is the one that we did last month was in a self-directed IRA. Okay. And the one we're going to do, the next one, I think we're probably going to finance it. We're not going to use cash on this one. And I'm not looking though at, can I save 3% or can I save 5%? I'm looking, what is my return? What's my return on investment going to be? Because you're right. What are my write-offs going to be? How much income am I going to be bringing in? Or that could I miss? So to run after sometimes dollars or, very little money, to try to predict what's going to happen is not necessarily always the best thing to do.
I agree. I mean, in many cases, they call that penny wise and pound foolish, right? And so, the reality is that the wealth created in this country is from long-term ownership.
That's right.
Right? I mean, I guess there's the magic pill of overnight success and so on. But the truth of the matter is that you have a long-range plan. And I think everyone has to kind of go into it with that long-range plan as well. The question becomes, what is that person's plan? And so I just happen to believe that, especially in our markets here and many markets all over the country, Florida has a lot to gain. We are getting the Northeasterners in droves now. I mean, when you think about the taxation, okay.
That's such a good point.
I mean, huge. I mean, CNBC had an article just 2 weeks ago, over 800,000 Northeasterners, I believe mostly from New York, are moving down to South Florida. You're seeing a lot of hedge funds move to Miami. So particularly for our neighbors here, there are a lot of compelling factors. Inventory is still going to be a problem on a macro level, just by way of housing starts versus demographic forces. Just the amount of humans. We have too many humans here, Kristin. Okay?
That's right. I think we're bringing in, 1,000 a day to Florida.
Oh, sure.
Okay, and that's crazy. You know, that's a lot. So, looking at that, and obviously in the different price points and things, you're going to see different, the market's going to be different depending on the price points of the properties and everything. But to not buy, to make sure that you're working with professionals. So people, realtors in the industry, like we've been in the industry now for quite a while, and I educate all the time, as well as Matt, professional in the industry that really knows how to guide and help our buyers. Right?
Oh, absolutely. I say right now, I was speaking to someone the other day and they said, so what's the magic formula today? And the magic formula, if you're looking to buy or sell, is literally the team you align yourself up with. I mean, when I say team, I'm referring to real estate professional and I'm referring to mortgage professional, right?
That's
to
right.
help guide you through that process. This is not an automated business. As much as the world wants to try to automate this, this is out of guidance, knowledge, experience to make sure you're getting your highest and best dollar. And then when you're purchasing, to make sure you're getting your highest and best dollar in terms of the right price. So, the team of professionals is worth its weight in gold in today's market. Look, maybe 3-4 years ago, it could have been anyone. But in today's market, this is where the experts are going to come out and shine.
That's right. And such a good point. I mean, we were talking about on another episode about FHA and the myths of FHA and VA financing. And that's another, you bringing in the experts, it's so important, just like Matt said, that you align yourself with that team of experts to really help guide you in the direction you want to go. Okay.
Yeah. Well, think about it like this. Okay. So we pre-approved 3 new buyers last week that were declined by 2 other lenders. Okay, so from a real estate agent perspective, if that agent was just working with just that lender, right, they would have basically lost 3 sales right off the bat. So that's where, if we're thinking from a buy side perspective, or by the way, even from a list side perspective, I always train my agents that if you get a decline during the loan process while you're under contract, please do not cancel and release. Allow us to look at it, because about 20% of my current production is what I call midstream transactions. Yeah. And these midstream transactions, we have the ability to resuscitate about 85% of them. Okay. It goes back to a financial advisor. You have 2 of them. One gets you a higher rate of return than the other. Same with the mortgage side, same with the real estate agent side, right? So your team in place can really determine from a real estate perspective your income.
That's right. That's right. So just ending this episode today and, just about thinking outside the box and different loans that are going to be coming along and the interest rates and the market and where we're at today. For our listeners, just give us a couple little things to take away from this that they should be looking for from the consumers to the agents. And also give us your information.
So from an agent perspective, I think we have to be as broad brushed as possible, right? We have to make sure that we have the right relationships in place that are taking their time up front and evaluating each and every one of our clients in totality. Here's what I call it inside the office, Kristin. I call it Rich Uncle. And what I mean by that is that if we have a buyer that at the surface doesn't look like they can get pre-approved, the question becomes, we always counter offer them with some alternative, because you never know, they might have a rich uncle. Yep. And that goes back to leaving no stone unturned. That's going to separate the winners in this market. That I can tell you. So for the agents out there, no stone unturned. From a consumer perspective, look, if we're betting on our economy, if we're betting on our country, which I happen to believe we're in the best country in the world from an economic perspective, from just a relations perspective. I mean, let's be honest, right? I mean, what's better than the United States of America?
That's right. That's right.
So amen to that. Now, with that said, if we're betting on the economy, then we have to understand that real estate has always succeeded and has always been a sound investment. Look, buyers, it would be scary if properties appreciated 25% per year. That's just insane. So we don't really want that. But how about this? How about 3 to 5% a year? That's some really nice appreciation. Oh, and by the way, in that mortgage payment, you're paying down principal. And by the way, you're getting a tax deduction. and we mathematically figure out the true cost of ownership, 9 times of 10, way less than renting. So don't be afraid of purchasing in today's market if you want to bet with our country and where we're going with it.
Wow, that's great advice. Thank you, Matt. And for our listeners, if you'd like to reach out to Matt for more information or, to talk about the loan process or anything else out there, make sure that, of course, you always mention the stamp of approval. Podcast is where you heard him from. But how can they do that?
Absolutely. Let me give you my direct cell phone. So 561-212-6503. Same cell phone number for 20 years, Kristin. You can go ahead and call me there. You can text me. You can tweet me. You can Facebook me, whatever you want to do. Link up with me on Facebook. I pump a lot of value out there, both consumer-based and real estate agent-based. It's just Matt Weaver. I don't know what else. Just look me up and see the guy with the gray hair, the premature gray hair, and you'll find me there. But also my email address, mweaver@myccmortgage.com is my email address. And like I said, we operate 7 days a week from 8 a.m. to 9 p.m.
Awesome. Thank you so much, Matt. Thank you for joining me today, and thank you, listeners.
Wonderful. Thank you so much.